All right, hello evening everyone. If you can hear me right now, type a comment in the chat box and let me know. Comment in the comment section actually. All right, let me know and we're ready to get started. Hey Anthony, nice to see you on the session. All right, how about the others? All good. We have the Facebook user. Oh my goodness. Hello, Facebook user. All right, now, so if you have seen the post that I've done over here, can you click on the www.streamyard.com/Facebook? All right, and then follow through with the approval for use, and then we can get today's session moving and started, okay? Okay, now, so thank you very much for joining me once again for the session. And today's session is going to be a little bit different. It's going to be a little bit special as well. All right, I've decided before the end of June to really run a session where I can educate and also bring to light what I've been doing over the last many months together with all of you when it comes to building this cash flow portfolio. All right, so this will actually be a session where it gives everyone more in-depth understanding of what I'm doing in these Friday sessions, and also know exactly what we are trying to achieve. Okay, because in the last couple of sessions we have participants where we talk about losses and talking about certain positions that we have are actually sitting on losses, where in actual fact, if you're building a portfolio from investment objectives, all right, this is not necessarily so. All right, so I just want to clear the air. I want to bring to light as well how such a portfolio is being managed and how do we manage our positions into actual final profitability. All right, so once you understand the concepts, we will resume our portfolio building next week. All right, and then we'll start adding new positions to what we have currently as well. Okay, now, so once again, for those of you who would like a copy of the infographic that I've done for selling portfolio puts, all right, please make sure you click on the share buttons, all right, because we will be checking back on the shares, all right, to identify who has actually done so, all right, and then after that, the team will be sending out the infographic PDF file to all of you, okay? All right, now, so if you have not done so, you could continue to do so right now. So it'll be awesome. And thank you once again for joining me. Okay, now, so let me get this session started. Give me a minute, everyone. Okay, I'm back. All right, now, so thank you very much. And let's get our sessions moving. So thank you for joining me every week in our portfolio building for cash flows with Terence. All right, and that's, of course, me over here in this session. All right, I'll just change the streams, all right, to the bottom. All right, so it will not block the views over here. All right, here we go. All right, now, so without further ado, let's get started. And whatever I'm teaching over here in this segment and this session with all of you today, all right, please treat it as an educational purposes, all right, and it's by no means any form of recommendations, all right. You do your own risk assessments, risk judgments before going ahead and do so, yeah. All right, Andy, all right, you can go ahead, go on Google and type infographic. It's like a poster. Yeah, all right, it's like a poster of a summary of what I'll be discussing today, yeah. All right, think of it like a cheat sheet. Okay, now, so portfolio buildings are Fridays. I'm calling and labeling today's session the Portfolio Cash Flow Builder. Right now, so we're going to be talking about selling portfolio puts, and then, okay, I'm going to talk about what lies in the benefits of the strategy. How do we actually use such a strategy? Now, who would this be for? Okay, and then we'll talk about some pros and cons. Okay, and after that, moving along, we'll talk about, if we have a headache, what happens after that? Okay, and then how do we follow through until we turn the trade profitable? All right, okay, now, so let's go ahead and do so. Now, so selling naked puts or selling portfolio puts, they are actually the same strategy. They actually are the same trade itself. Okay, but the difference in nature, all right, is that most people who sell naked puts, right, they will do such a trade based on margins, right? That means they will take leverage and then they'll sell the puts, not putting up the full cash requirements in the event that something happens, right? But when we label portfolio puts, right, the difference right now is we sell naked puts, right, but we are trading, right, based on the full cash requirement, right, full cash requirement. Now, this can actually be seen as well, because if you open up a brokerage account with cash only, that means you're opening up a cash account, right? When you sell naked puts, the brokers will take the full cash amount for the shares, okay? But if you're trading on a margin account, right, then they will allocate the margin requirements, okay? But be aware, anytime you take leverage, right, and the stock moves against you, right, the broker always has the right to call for more collateral, right, which means more cash up front, okay? All right, now, so for put option sellers over here, what's the main benefit? What's the main thing that you get, right? The first thing up is you basically collect cash, right? Because we are sellers, all right, hence in the action of selling, right, we're gonna get paid, right? So the very first thing that we get over here in this transaction, right, is the fact that we get cash, all right? Okay, now next, right, our views when we do such a trade is basically we just don't want the stock to go crashing, right? The stock going up and down normally is really fine. Yeah, okay, because as you have joined me in my previous sessions, you have noticed that I tend to like to sell them at strong support price levels. Okay, and also when, okay, a stock that is strong fundamentally, right, is already trading at a pretty cheap valuation. Okay, now, so as long as it does not crash, my trade should work really fine. Right now, and another benefit that you get as an option seller versus an outright stock buyer is this: when you buy a stock, the moment it goes up, you make money. The moment it goes down, you lose money. All right, so it's make or loss. But when it comes to selling options, because of this benefit, you're collecting cash up front. Right, whatever that you're collecting, all right, has gone into a collateral for your first loss buffers. Now, so let's say if I sell a put option and collect $1, right? Okay, if I lose $1 on the share, right, you have to remember, right, that I had this $1 buffer, right, from the premiums that I've collected when I sold the options. Yeah, okay, all right. Now, so what you achieve over here is you achieve what we call a break even before a loss scenario. Yeah, okay, because there's collection up front, so you achieve a break even before a losing scenario. So there's another benefit that we get. Now, so what are you getting paid for? Because obviously when you sell a put option, right, you get people to pay you, right? But of course, money is not free. So what exactly are you promising, or what exactly are you doing in return? All right, you're offering your other party, right, an obligation, a potential promise, right, to actually buy their stock. Right? It doesn't mean that you have to do so because of this very important word called potential. Yeah, okay, but you are making a promise. Right? So once you collect the cash, right, you are not in the decision maker's position. Right? The decision making lies in the counterparty. That means the buyer. Right? The buyer is the one that has the right to choose, right, whether to do this or not to do this. Right? Once you collected the money, right, you can only wait and see what they want to do. All right, so think of this like an insurance company. All right, once an insurance company collects money, all right, from the client, all right, the policy is activated, correct? All right, now, and they cannot choose anything after that, right? They just have to wait and see if the clients will be initiating any claims at all. Yeah, okay, until the policy expires, right? So options work pretty much the same way, right? But if your customers claim, right, your point of action, yes, that's the right way to say it. Your point of action is the promise that you buy their stock, right? So that's where I said when you do this the portfolio way, right, and you sell portfolio puts, right, you already have the cash prepared to buy the stock. Yeah, if it doesn't happen, you still make your money. Yeah, all right. But if it happens, your money is already there, right, to buy the stock. So you don't have to go looking for more money or anything like that, right? So this is actually one of what we call the safest and the most traditional way of selling options, right, in the form of a portfolio methodology. Yeah. Okay. So that's why I keep emphasizing week after week, right? This is coming from an investment's objective, right? So how you pick investment trades and how you pick trading-based trades are always different, right? Because if you're trading for the short term, trading for the near term, right, you're always gonna have to look at some technical indicators, right, to try to get a pointer. Right? But when you're trading for an investment objective, right, your horizons are usually much longer. right? So you can or tend to ignore the market timing. Yeah, okay. All right, now, so what is always present when it comes to any options that you trade? All right, in options that you trade, there's always two key elements, right, which is what we call flexible. Number one, all right, you always have the choice of what we call the strike price. Now, the strike price is really what we call also the agreed price to transact the final stock at. So here we're giving an obligation, all right, or we're taking on an obligation to buy the stock. Right? But of course, if I'm buying a stock, I want to know what price am I promising to buy, right? So this strike price will be the promised price to transact the stock at, okay? Now, and it's for me to choose. So you see where's the good part over here, right? I get to decide, right? What price do I want to pay for the stock, right? If I'm not happy with it, then I should not just sell it, right? I should be selling put options with strike prices that I'm happy to own the stock at. Yeah, okay. Now next, right, I choose a deadline, which is called the expiry time to that option, right, that I'm also comfortable with, right? If I want it to expire in 2 weeks, then I'll pick 2 weeks. If I want to trade for a month, then I'll expire for a month, right? If I have a longer outlook, let's say for 6 months, then I'll pick a 6 months option, right? These are flexible, yeah? Okay, now, so when you're selling options, you operate pretty much like a business owner. Yeah, all right, because the right is not in your hands, you don't get to choose, right? You just collect the money from someone, right? And you got to wait for the whole deal to end, right? Sort of in this scenario, right? Now, so next, how do you use this strategy? Right, first, you have to be bullish in the long term, okay, with the stocks that you're selling put options on, right? This has to be the first key element, right? Now, I'm sure you have heard of a lot of horror stories where people sell put options, right, and they end up being dead. Right, dead in a portfolio sense, okay, not really in a life and death matter. Okay, now, so they end up busting their account. Why? Because, if you end up selling on any stocks or put options on any stocks you are not willing to own, then that's always going to pose a problem. Right, now, why? Because if you're not willing to own a stock, usually the cases are, right, it's a very volatile stock, right? Second, it's not a very safe stock, right? And three, right, there's always going to be an element or what we call a chance, right, that the stock that you don't intend to invest and hold, right, can actually go bust. Right, see the problems now? Right, now, so you flip the story around, okay, and I put in brackets over here, this is more practical, right, when done on stable and undervalued stocks. Why? Okay, think blue chips, right? Now, how do people trade blue chips? People trade blue chips when they're cheap, right, and then they go in and buy them, right, and then when they go up, right, in price, then people tend to take their profits. Agree? Right, now, and it keeps seesawing this way. Yeah, okay, now, so we are going to do the same thing, because if we sell put options first, when these great stocks are already cheap, right, that means the prices have already been depressed, okay, to an undervalue or a low price level. So then, all right, we go and pick, all right, a price that we're happy to own the stock at, okay, and we choose to sell a put option by collecting premiums. Yeah, now, so if the stock still plunges, that's perfectly fine, because a cheap stock, all right, has just gotten cheaper. Yeah, okay, so it's only going to get to that much cheaper before we're going to expect a bounce. Right, see the logic now? Right, because if you buy a blue chip stock and it was already cheap when you buy it, okay, if after you have bought it, all right, it keeps going down, what are you going to do? Are you going to choose to cut your losses? If people buy blue chip stocks, very few of them actually do, right? Yeah, because if it was a trading stock, then yes, you cut the position because the trade went against you, right? But if you're buying a blue chip stock from an investment angle, an investment perspective, I'm pretty sure you're comfortable to hold on to that stock, right? Because you know it's going to turn around, right? It's going to be profitable. So that will be the first basis and the most important call when it comes to choosing the stocks that you want to do this on. Yeah, okay, so I hope you get that point over here, right? And this is very, very valuable, okay, because if you continue to do it this way, I promise you, all right, if you do this plus the portfolio way of selling put options, all right, you are taking on very, very little or no risk, right? Very little or no risk, right? So you're learning how to do it right over here. And the best part is you're getting it all free today from me. Yeah, okay, I'm in the mood of sharing, I'm in the mood of giving today, all right, so I've decided to do this. Okay, now, and many of my students know this as well. When I decide to do something, all right, I usually do not hold back. All right, so if you listen very carefully to what I tell you today, all right, there will be many, many golden nuggets, right, that you'll be able to pick up. All right, that is actually not free usually. Yeah, okay, now next. So the next question you should ask is, oh, Terence, I found a great stock. So the next question you should ask is, right now, when you see the stock price, do you consider this price as fundamentally cheap? Right now, I'm not going to go into all the valuation models because this session is not built for that, right? But the simple thing is you have to consider at this price right now, is this stock considered cheap, right? Because when you sell put options, when the stock goes down, right, you potentially have to buy the stock. So why would you want to do this when a stock is considered expensive? Agree? Right? If a stock is very expensive right now and then you sell the put option, right? Yes, you can make money, all right? But sooner or later, all right, a correction is going to hit that stock, right? And the correction can be pretty severe, right? And you don't want to get stuck or you don't want to get caught when something like that happens, right? Now, I just want to, I'm not going around to bash, but I just want to show you a potential threat and a potential danger, okay, when doing this on overvalued stocks. All right, because Tesla was the darling, right? Okay, and when Tesla was going all the way up to $900, right, at such a high point, right, at that point itself, the PE valuation of the company was over $1,000, right? That's never a good time for you to continue such a strategy of selling portfolio puts, right? First, because the stock is highly valued, right? Second, is it enjoyed such a great run, right? It's clocking new highs every single day, right? And of course, number three, all right, when it comes crashing or when it comes correcting, all right, you may be left, right, holding the baggage, right? So you can see over here, if you sell it at 900, all right, and then after that you're made to buy the stock, okay, you're holding a $900 stock that is only worth 680 right now. Okay, and the worst point was it actually went all the way down to 550, right? That's like almost 50% down, right? So you see why I said it should be done, right, on fundamentally strong stocks, right, as compared to hyper growth stocks. Right? Because hyper growth stocks are going to give you this potential problem. All right. And you don't want to build a portfolio where your heart has to be racing, right, almost every other week. Right? When you pick such a portfolio strategy, right, you want it to be as calm and as boring as possible. Yeah. All right. The return should be the only thing, right, that actually excites you. Yeah. Okay. So ask yourself, is it considered cheap? Right. Second, all right, next. All right, ask yourself, what is a dream price that you're happy to own the stock at? Yeah, okay. Are you comfortable owning the stock at this price? Okay, once you know that price, that will be your first sight of the strike price that you will sell the put option at. Yeah. Okay, now, then the last one would be, all right, to check the premiums that are available for that strike, okay, or that price that you're happy to own the stock at. Okay, how much are the options going for, right? And then calculate your returns and see if it hits your target. Right? Because it's really pointless if you sell a put option, right, that pays you like 1% per annum, right? Because 1% is probably what you get if you put it in fixed deposit anyway. Agree? Right now, so you definitely need to first set a goal. Terence, I want to do this and I'm aiming for 10% per annum. Right? Then make sure you get this. Right? So you pick a put option strike, and then if you're selling 3 months at a time, so you're going to be able to do this 4 times a year, right? Now, so make sure every time you sell a 3 months put option, right, it's going to pay you at least, all right, 2.5%. You see where I'm getting at? Yeah, because 10% is your target, right? So if you break it up into 4 parts based on your preference model, right, then each part should be paying you 2.5%, right? So you're taking a stair-step approach to getting your target, right? So if you're going to do this every month, right, then 10% must be achieved over 12 transactions, right? So that's roughly about 0.8% every month. Right, so you see where we're getting at, right? So if your targets are 20%, then you need to be selling a monthly option that pays you about 1.2, 1.5%. Yeah, okay, so that's how you plan your goals and your aims over here. All right, now, so when you choose a put option, let me show you some of the examples over here. So this was Wells Fargo when it was still trading at $24, right? So this was sometime in August last year. All right, I'm just taking a quick example. All right. Oh, this was sometime in July, actually. Or was it in June? Oh, my goodness. I can't remember the dates. I don't have it here. Okay, but what we did over here was we sold a 21st August 1750 puts when the stock was trading at $24. Yeah, okay. Now, this put option had about 90 days left, right? So you can see on the diagram, right? The numbers in brackets will mean how many days left to expire, right? So this trade had about 90 days left, which is 3 months. right? So this 3 months option, if we choose 17.5, pays about 56 cents, right? So if I sell this put option, somebody's going to pay me 56 cents per share. Yeah. Okay. Now, so what will be, all right, my return on investment? I just have to take 56 cents divided by, all right, the 17.50, okay, that I have to put up to own the stock or to buy the stock, right? And that will give me my ROI, right? Okay. Now, but at the same time, my break-even price on owning the stock is actually not 17.50, right? Because I have to buy the stock at 17.50. But if I end up doing that, I have already collected 56 cents from selling the option, right? So my break-even price is actually 16.94, right? And not the 17.50 that I'm actually going to end up paying. So see the difference right now? Yeah. Okay. Now, so if that is done, let's go to the next step over here, right? And let's do. This is how the trade looks like. So the stock was sitting over here. Oh, moved the wrong stuff, right? So the stock was sitting over here, right, while we sold a $17.50 put option. Now the break even is over here at 16.94. Now what it actually means to use this, anywhere, all right, anywhere where this green arrow is, okay, if the stock lands anywhere, right, above the red line, first things first, your put option is going to expire without claims, right? That means you don't have to buy the shares at all, right? And of course, you're going to end up making that 56 cents as your profits. Okay, see where I'm coming from? Now, but if it ends up below the red line, right, yes, your customers are going to initiate a claim, right? Yes, you would have to buy the stock, okay, but it doesn't mean that you have lost money yet. See where I'm coming from, right? Because if you bought the stock at 17.50, okay, but the current stock market price is 17.10, right? After buying the stock, you can sell away the stock at 17.10, right? And you'll realize that you still ended up the whole trade with a profit. Yeah. Okay. So a lot of people like new to options, right? They tend to get overwhelmed. They tend to get caught. But you realize it's actually just math. It's actually just numbers, right? Where is money coming in? Where is money going out? Right? Am I making money or losing money at the end of the day? Right? So if you do a plus minus model, right, and then put the equal at the end, right, you should get the final answer. Yeah. Okay. That you're looking for. Yeah. Okay. Now, so I hope that helps you over here in terms of what we're doing. Now, so in our 3 case scenarios over here, if the stock goes up to $30, then we keep the 56 cents, right? We end up making about 15.7%. Did I get it right though? Right, let me make sure I get it right because that's 56 cents divided by 17.50. No, that's wrong. Right, I used a different one over here. Right now, so that's about 3.2%, right, in 3 months. Okay, so that's about 3.2% in 3 months over here. Now, if the stock doesn't move, it stays where it is currently, you're still going to end up making the 56 cents, right? Because that's what you collected from selling the put option, right? And that's going to be your maximum profit as well. Yeah. Okay. Now, but if the stock goes down to $15, okay, what you have right now is you have a loss of $194. Okay, because you would have to buy the stock at $17.50, and on paper it is only worth $15. Yeah. Okay, but it also means you are owner of a stock, so you can hold the stock right now and then wait for the stock to go back up. All right. So see where I'm driving at? Because at $24 back then, Wells Fargo was already very cheap. Yeah, Wells Fargo was considered very cheap back then at that price. Okay, and of course, subsequently, right now. Okay, we can all see 1 year later, Wells Fargo is trading at $46. Right, so can you see where I'm driving at? Right, let me change this to 1 year. Right, there we go. Right, so the trade was probably somewhere here, right, when I was trading 24, 25. Right now, so even if you had to buy the stock because of a dip over here, right, and you end up holding the stock, you would realize that until today, right, you would still have ended up making a profit. Yeah, hence the fundamentally strong, right, but undervalued stock, right? So eventually a problem, right, can actually end up resolving itself. Yeah, a problem can actually end up resolving itself. Yeah. Okay. All right. Now, so this is why I say stock selections is vital. Stock selections are very, very important. Now, so if you could do me a favor before I continue to the next step over here, all right, help me click on the like buttons for this video if you enjoyed the session so far and you feel like you have learned something so far during the session where I'm actually trying to share more information with you. Yeah. All right, now, so I'm going to go ahead with talking about some of the pros versus some of the cons when it comes to selling portfolio puts. Okay, now, so the first benefit that you're going to get for sure is the fact that you actually end up getting paid, right, to go out there and own and buy shares. Do you realize that? Yeah, okay, because what's our ultimate outcome, right? Our ultimate responsibility is we may have to, right, end up buying somebody's share. It doesn't happen. We don't want it to happen, but it is there, right? But because we sell the put option, somebody's actually going to pay us money up front, right? So I'm actually getting paid to own shares, right? Plus, right, I get to pick my own price. Do you realize that? Right? I'm supposed to sell a put option where I'm happy to own the stock at that price. So you actually end up picking your own price. If you don't like it, then make sure you don't even sell the put option, right? It has to come from the angle. You're building a portfolio. So how should you build your portfolio? You should build a portfolio based on stocks you're willing to own, all right, and at prices you're willing to buy them at. See how it ties in together? Don't do anything different, right? Which means, okay, if you will build a portfolio this way, all right, don't sell portfolio puts in a different way, right? It should be done consistently. Yeah. All right. Now, next one over here is we get the benefit of time decay. So usually a lot of these fundamentally undervalued stocks, they don't rebound immediately. All right. They like to form what we call a bottom. Yeah. Okay. So you can see over here, Wells Fargo. Let me go back to Wells Fargo. All right. Wells Fargo literally tried to find a bottom all the way from June, right, to almost November, right, before it broke out. So during this whole time, if you own the stock, right, you would have made nothing. The stock was cheap. The stock was undervalued, but still you have made no profits at all, right, because the stock didn't explode. Okay, but if you sold put options, right, these put options will keep expiring, right, week after week or month after month, right? And if 56 cents was what you got, right, you'll be collecting 56 cents a couple of rounds over here, right? So see why there's a benefit now? Yeah, okay. Now, so you get a benefit of time, okay, when it moves towards expiry, all right, your options are going to be worth zero, right? So whatever you collected upfront is going to end up being your profits. Now, next, right, you are also given what we call the margin of error, okay, margin of error. Now, if you look earlier at our trade on Wells Fargo, right, our error is in fact, when we started, the stock was 24.44. Right, we could let the stock drop all the way to 17.50, all right, and still see this option expire worthless, right? So when it drops, in theory, we are already wrong. We would like the stock to go up. We are wrong. It went down, okay, but we still end up making profits. Yeah, so see how it works now? Yeah, okay, now, so you get the margin for error over here, which is actually the biggest safety. Now, what are the cons then? The cons is if you do not choose the stock correctly, right, your losses are unlimited all the way to zero. All right, first, because you have to buy the stock. Second, if the stock goes to zero after you buy the stock, then you lose everything. Agree? Right? Hence, I keep emphasizing and re-emphasizing stock selection is key, everyone. Stock selection is key. Yeah, okay. Always start with choosing a stock you're willing to own first. Right? In fact, let me add on to it. Always start doing this on a stock where you cannot even visualize, right, a bankruptcy happening to it, right? Because if you cannot even visualize a bankruptcy happening to that company, right, then this worst case scenario is never ever going to happen, right? So see where this risk is always portrayed in books and informations on websites that you read about selling put options, but it's actually controllable, right? It's actually controllable. Yeah. Okay. Now, next, bankruptcy risk. So like I said earlier, it's controllable, right? Just make sure you choose stocks where you cannot even foresee that you'll go bankrupt. Right now, if you ask me, Terence, what do you mean? For example, think Intel, right? Do you really ever see Intel going bankrupt? Right? I would believe if it starts to, fall or demise over here, touch wood, right? It's one of my favorite money-making stocks, right? But if there's a demise on Intel, right, you bet that some of their competitors, all right, are probably going to be willing to swallow them up, right? Hence, they'll still not go bankrupt. All right, see where I'm driving at? Okay, now, but the only biggest downside that you cannot control, that you should never work around, is the fact that when you sell put options, the portfolio weight, so portfolio puts, right, you will require a big capital upfront, right, to do this right, to do this well. Yeah, okay, so that's really the only downside. Okay, but despite the big capital, if you are able to do so, right, it is actually realistically capable, all right, or very simply doable to build a portfolio with such a simple concept that pays you anywhere from 10 to 20% per annum, right? And this can be done consistently as well. Yeah. Now, so let's talk about a what if. Now, so a lot of students, a lot of attendees on Fridays have always asked, Terence, what if, what if, what if, what if? All right, so let's go into the what if as well. So what if the stock collapses? What if the stock does crash? Okay, because I think we have done 50, let's see what's our record so far. All right, we have done 56 live trades so far. Okay, and we had only 2 assignments. All right, that means only 2 occurrences where the stock actually went below our strike prices. Right, over the last, I think, almost 10 months right now. Yeah, okay, only 2 stocks out of the entire list. Okay, but yet we have closed those 2 stocks for profit after that. Yeah, okay, so I'm not too concerned with how I do things because of my stock selection. So that's key again. Now, so what if the stock drops? So this is what you're going to do. When the stock drops, number 1, you can choose to just hold the stock and then wait for the price to go back up. So that's a very simple one. You bought a stock, the stock price right now is below what you bought for, right? You just wait for it to go back up and then you have your profits, right? That's the simplest way. But while waiting, right, you can choose not to be what we call a sitting duck, right? So a lot of people just sit and wait, and you feel helpless, right? Apart from praying, of course. Okay, now, another thing you can consider doing is now you own the shares. Okay, you can actually turn around and continue to sell options. Okay, but no, you cannot sell put options. You don't want to buy more shares, right? So instead, what you're going to do is you're going to start selling, right, the call options. Okay, why? Because the call options obligation, right, is the opposite, which is to sell the stock. Okay, so see where I'm coming from now? Because you're still an option seller means when you do this to the call option, you're going to collect cash again, right? So now you're going to get paid, right, to sell your stock. Right now, so I want to ask a question before I go ahead. If you are getting paid to sell your stock, okay, to sell your stock, can all of you leave a comment and tell me right now? Okay, I'm going to wait for it because I know there's some lag over here. All right, now, can you tell me right now what kind of scenario are you willing, right, to sell your stock at? Yeah, okay, type one of the 3 that I'm going to show you below, okay? Okay, all right, now, so go ahead and leave in the comments, all right, at what kind of situations are you willing to sell your stock at? Okay, are you willing to sell it for profit? Okay, are you willing to sell it for break even, right? Or are you willing to sell it even for a loss? Okay, if this was an investment stock, okay, that means you are intending to hold it for the long run, right? Type it out, everyone. All right, so we have Eileen over here saying, for profit. We have Ivy saying higher than my buy price. All right, we have Travis saying, for profit. We have Donkel saying for profits. Yeah, okay, now, so everyone's got the idea. All right, now, if this is a stock, you see, now you know exactly what you're doing. Because if this is a stock that you have bought because you're willing to hold it for the long run. Yeah, you know exactly what's your get out plan. You see, you know what's your get out plan. So if selling a call option, all right, if selling a call option means you have to potentially sell your stock, then what kind of a strike price should you choose? Because you have to choose the strike price again, correct? So what kind of a strike price should you choose? There you go. You have the minimum strike that you should be choosing. So you know exactly how to do this then. Yeah, okay. Now, so moving along. Oops. So when you sell call options, there will be 2 scenarios in which you should actually activate and sell your call options. The first one, right, is where you are max profit focused, right? Okay, you're max profit focused. So what you'll be doing over here is simply this, right? You are going to look for a call option strike that is higher, right, higher than the assigned price where you bought your stock at. Why? Because if you pay this amount to buy your stock, okay, and you get to sell your stock at this price, what does it mean? You still end up with a profit. See, yeah, understand that? All right, you bought your stock here, you sold your stock here. Still, you made a profit, right? And that's the ending scenario. Yeah, you made money. Yeah, now even if, right, even if you say, Terence, but my break even is just, sorry, my focus is just to break even, then that's simple. Just make sure you at least sell a call option, right, where the strike price, right, is what you paid for the share. Because if your shares get taken away at that price, right, actually without you realizing, right, you still end up with a profit because you forgot that when you sell the call option, you collected some premiums. So your break-even price was actually here at the blue X, not the black one. The black one is where you paid to buy the share. Okay, but your true cost was actually lower than that. Right? So if somebody took your shares at your assigned price, you still actually end up making a profit. Right? But of course you lost time, right? Because more time was being used up. That's all. Right? You lost time. Yeah, but that's okay. Right? If you believe the fact that stocks go up or tend to go up in the long term or in the long run, right, then this strategy, right, is the simplest way for you to make money over here. Because when it doesn't go up, you make money. When it goes up, you make money as well, although it's limited, but you still make money, right? And when it goes down, you just temporarily do not make money. So you see where we're going. You don't lose money, you make money, and you make limited money, right? So it's make money and make limited amounts of money, right? But there's no losses. All right, so that's why I keep telling people, all right, this is the best and the simplest way you can build a portfolio out there. Now, but some of you are always going to ask me this question, all right? So this fear focus where you just sell it, right? You just want to get the trade out and then restart again, right? Now, but somebody's always going to ask me, but Terence, what if the stock really crash and die? Right? While I'm owning it over here, all right, it really crashed and die over here. Then, what are you going to do? Yeah, okay, what you're going to do is this. You may do what we call a damage control. Yeah, a damage control. Now, but before you do a damage control, please understand this, right? If you choose to sell a call option where the strike is below the assigned price, that means you paid this X amount, right, to buy the stock, and now, right, you potentially have to sell the stock at this rate line. You are potentially setting up a loss scenario. Okay, so the only thing you can do is to make sure this call option that you're selling, right, is a hard resistance, right? You do not expect the stock to break past this price within this expiry time that you're selling the call option, right? Why? Because if the stock is at this blue X right now, there is no premiums for you to get, okay, if you sell a call option at this strike, right? The premiums are probably going to be zero. So if you are saying, but Terence, I don't want to sit there and wait. I want to collect, if it's 20 cents, it's 20 cents. All right. I'd rather keep collecting 20 cents every 2 weeks while I'm waiting for the stock to recover. Right. There and then you have to first decide, am I willing to take chances? Right. So what do I mean by are you willing to take chances? Are you willing to take chances, right, that there may be a losing scenario? Right. If you say, yes, Terence, I'm okay with that. Right, if I'm wrong, I'll accept it. I'll move on. Okay, then, all right, you can choose a strike where it's a resistance price for that stock. Yeah, okay, it's resistance price for that stock. Okay, all right, then, how do I say this? Now, so over here, okay, so what we can say over here is this. If we saw a put option here, right, we should never be doing that. But if we did that and we saw a put option at this line, which is $34, right? Okay, and then the stock collapsed, all right? The stock collapsed over here. Now, so because it's so far lower than our strike price, okay, I won't be able to get any premiums for selling 34. So there, I have to decide, okay, the possible resistance is somewhere here. Let's say 33. Okay, am I comfortable, right, with a potential $1 loss? I paid 34 for the stock, all right? And right now, if I sell the 33 call option, right, I may have to sell my stock at $33. So I will lose $1. Okay, am I willing to take the chance of losing $1? Yeah, okay, now if you say, yes, Terence, I think the resistance will hold, then by all means go ahead, right? Because when the stock rebounded, all right, it still took almost 2 weeks for it to finally break out. So if your option expires in 2 weeks, maybe, right, your option will have already expired before the stock actually broke out. Yeah, all right. So you still have made the extra premiums. Yeah, okay. So something along those lines over here, right? So the risk is basically the fact that you may have to end up losing that stock at that price. Okay. So Andy, like what you said over here on the Mandela, right? Mandela was simply a stock choice over here, right? If you remember what I said about Mandela, if you actually listen very carefully, right? I said Mandela is one of the few growth stocks, right, that I'm willing to sell put options on. Right, and the key word right now was growth stocks, right? So when you are trading portfolio puts on growth stocks, they should be handled differently, right, from fundamentally strong but boring stocks. See the issue right now, right? So for growth stocks, you should be waiting for a bounce, right, before you take any choices, right? You should not be selling any call options, right, when they have hit their rock bottom. Yeah. Okay. So it's pretty much boiling back to the first core fundamental, the stock selection, right? Based on the stock that you've chosen, how should you handle, right, the entire trade process? Yeah. Okay. Right now, so Facebook user, right? Can you do me this, right? Can you identify yourself, right, by making sure that you click on the streamyard.com/link over here, right? So you'll find this post, right, where it says I plan to go live, right, and then streamyard.com/Facebook. Or in fact, you can actually just type it on your browser right now, okay, on a separate tab. Okay, you'll be brought to the page and then just click on the blue color Facebook button. Yeah, okay, after that, we should be able to see who's leaving comments, yeah? Okay. All right, so actually, I've just answered your question as well. So to answer your question, this will be the scenario. So you either just wait, all right, that means you continue waiting, all right, or when you, you either continue waiting or you have to make a decision, hey, I see a very strong resistance price, all right, maybe I can sell that as the call option strike, okay, and see what kind of premiums I can collect. Yeah, okay. Okay, now, so why would you use this strategy and when do you use it? First, right? It will be used for driving cash flow from stocks, right? So usually they are what we call the boring or channeling stocks, okay? Boring or channeling stocks, right? Second, right? Because you are now owning stocks, okay? So this is used as a form of generating cash flows or extracting cash flows while I'm waiting to get out of this stock position, yeah? Now, next, you are basically always going to exchange potential profits, okay, for the upfront income. So once you sell the option, once you sell the call option, you have basically capped the maximum profit on that stock, right? Because once it crossed past that price, okay, somebody is going to make you sell the stock to them, right? And you won't make anything more than that, okay? Right now, lastly, this is pretty much as a damage control, okay? Pretty much like a damage control over here. All right, so that's probably what you want to do in CEO. Okay, let me drive a better scenario. Let me try to bring this back to 2 years, right? We should be able to see that. 3 years will work. Now, so let's say you are unfortunate, right? Very, very unfortunate over here, right? Where, you know, you had this market crash and then you try to bargain hunt, right, on the rebound and you say, oh, it's going to rebound. I better chase it right now. And then you sell, you know, like a $31 puts, right? Okay, on Wells Fargo. Now, and after that, of course, it collapsed further, right? And you are now caught. So see what I mean by you are now caught, because the stock is at $24, right? And you paid $31 to own the stock, right? Surely you're not going to get any premiums at all for a $31 call option. You get nothing, right? It's not even worth selling if you get anything at all, right? So you have to consider, perhaps after seeing this, the way it trades, right, that $26 is probably a good call option that you can sell. So while waiting for it to channel like this, right, you can constantly sell the $26 call option, right, again and again and again, right? If you can see over here, right, it's like from July, right, all the way to November before it broke out, right? So from July to November, you might be able to collect, you know, about a few dollars, right, in terms of option premiums while waiting for the stock to recover, right? So this is clearly what I mean when I say damage control. Okay, damage control. Yeah, okay. All right, now, yes, so, yes, side. So what you can do right now is start planning. Okay, so side, like what you say over here, right? Your scenario will be pretty much similar to what we just said over here with Wells Fargo, right? So if you know that that's pretty much the highest that you're seeing or getting so far, okay, I'm not making any recommendations over here, side. Okay, but if you look at what if you look at what MO is doing right now, okay, it's probably going to see a resistance at 48, right, and then another resistance at $50, right? So those are two strike prices that you can look at, okay, and when there are premiums available for them, right, you can consider collecting some cash flow, right? So that's how I would do it if I'm trying to think of damage control. Okay, if I'm thinking of damage control, that's how I handle it. Yeah. Yes, Andy, that's definitely what I mean. Right? There is no compulsory need, or there's no one forcing you, right, to sell that call option immediately after you own the stocks. Right? In fact, usually if you're made to own the stock, right, the prices are usually disadvantageous to you because it would have fallen, right? So wait for some kind of a rebound, right, before you start selling any call options. Right? Why would you want to sell call options when the stock has hit the bottom? Correct? Yeah, you want to sell call options after a rebound, right? So that's what you should have done over here. Yeah, okay. All right, welcome, Said. No problem. Okay. All right, everyone. Where am I? Okay, now, so let me get to the entire cash flow loop right now because I've just gone through, all right, everything that you need to know when it completes the loop. So most of you have seen me do this. Okay, so most of you have seen me do this on most of our trades, which is called selling portfolio puts. So week after week, we're identifying new trades that pay us a decent premium, right? That helps us achieve about 20% per annum goal target, right, for these trades. Yeah? Now, so I aim to collect cash flow instead of owning the stocks. Okay, and I always put up full cash allocations, right, for any trades that I take on. Okay, full cash allocations for any trades that I take on. Now, if I'm assigned, okay, if this expires or if I close the trade for a profit, then it ends, right? I look for the next opportunity. So I go through this over and over again. Yeah. Now, if unfortunately the stock falls and I'm assigned, then I go to step 2, right? So once I own the stock, I simply wait, right? I simply wait for the stock to recover, right? Or I can do this as well. Okay, I can choose to sell call options, right, to accumulate more cash flow. Right, it will help to bring down the break-even cost of the stock itself. Yeah, every time I sell a call option, let's say I collect 30 cents, the cost of my shares just went down by another 30 cents. Right, so I'll keep doing this, either holding the stock, selling call options, holding the stock, selling call options. Right, I'll keep doing this until, right, the trade that I have can be exited, right, with a profit outcome. Right, so once I can exit with a profit outcome, I will get out of it and I'll restart all over again. Yeah, I'll restart all over again. Yeah, so that's how I do it. Now, even if the stock price is still very cheap, right, I would still sell the stock. The reason is because once I sell the stock, I can resell a portfolio put with a strike that's lower than that. So I restart my margin of safety again. Rather than owning a stock where it goes up, I make money, it goes down, I lose money, right? I always like to be in a position with a margin for error. Yeah, see where I'm coming from? Right, so the moment I achieve profitability, all right, I'll usually close that trade. All right, even if it's a stock, I'll close the entire trade or find a way to do so, right, and go back to a portfolio put. Yeah, okay, right. So we'll do that now. So the key thing I just want to say and emphasize one last part before I wrap up this training, and we'll look at portfolio management. Okay, is this: you can adopt a start-stop approach. Which means when you sell a call option and when the call option expires, if the stock price is not favorable on that day for you to sell the next set of call options. Wait, right? Wait for the rebound, right? Just like what Andy said just now, right? If I happen to see today's expiry, but the stock is hitting the bottom or the support price level, why would I want to sell a call now? If it hits the support, we expect it to bounce. So why don't I wait maybe 3-4 days later, right? When it bounces, then I find a call option to sell. Makes sense, right? Right? Because a lot of new option traders, they keep thinking, oh, this one is expired, I need to start the next one. No, all right? Starting a trade, all right, 3-4 days later doesn't really disadvantage you much. Yeah, especially, right, if you see a move that is going to be in your favor, right, that's going to help you, right? It's actually better to be patient, wait it out, right, get the move that you want, then sell the option. Okay, everyone? All right, now, so this wraps up the short little mini course or mini training that I wanted to do today. All right, and remember once again, right, if you have not clicked on the share buttons, all right, help me do so. Okay, and we will be getting the team to send you an infographic that I prepared for portfolio put selling, okay, based on what you heard me say just now. So I'll put in the cheat sheet guide, okay, all the key elements, all right, to doing this right. Yeah. So if you want a copy of them, all right, just help us click the share buttons for this video. Yeah, all right, and we'll be giving out and handing it out to you. Okay, now, so before I wrap this session up, let's go to our portfolio positions. Yeah. Right, so let's look at some of our trades right now and where they stand, okay? So we have JD. Right, so we have a JD 21st January. After the recent bounce, right, there should be some profits on this, but let's have a look, 77.50 points. Yeah, we have. Look, everyone. So many of you were, literally cursing and swearing, all right, for a while right now because, all right, the moment we sold this trade, all right, we were sitting on losses, right? Now, so can you see we collected 935, okay, when we sold this put option in April, okay, for a 77.50 put option, right? And where are they right now? How much is it worth right now? There we go. All right, see, we could close it today for 780. All right, so I could close this put option today for 780. Right, it would still give me a profit. Correct? Yeah, it would still give me a profit. No, so the key is this. All right, fundamentals. All right, fundamentals on stocks. All right, so we got in over here in April. Right, so yes, the stock dipped on me. Right, but I was clearly comfortable with owning the stock at this black line. Yeah, okay, and today we see that come back. Right, so if you find a great company, right, and know that the fundamental valuation is achieved, right, then this is a great strategy, right? Because even when you're wrong, all right, there's always a comeback, right? This is like what we call the comeback trade, the ultimate comeback trade. Yeah. Okay. Now, next one, let's look at our VZ position, right? So we have a VZ 16 July, right, 57.50 puts. Right, we collected $2.03 for that. Let's see what it's worth right now. All right, still a slight profit, 190 perhaps. All right, 190. All right, so that's pretty decent. All right, the stock has went down actually. All right, but we still have a profit, so that's good. Yeah, so about 13 cents profit. Nothing fantastic, but 57.50 is our strike, and the stock right now is $1 lower than that. Look, it's 56.39. All right, and we still have a profit on this trade. Right, you can't really complain, right? Yeah. Now, next one over here, Cardinal Health. All right, CAH 16 July 57.50. Oh, another stock that's below the strike price. All right, so technically, in theory, we are in trouble, right? Okay, but let's look at our trade right now. We collected $2.30. How much is it worth today? Look, everyone, I can close this for maybe about 175, 180. Yeah, right. The bid ask 175, 180, right, and that still gives me a profit, 230, right? That's like a 50-cent profit, right? In what, 1 month? Yeah, 50-cent profit in 1 month, right? That's like 1%, or close to 1%. Nothing to shout about, but I didn't lose money, right? Yeah. Now, next one, TUP. Nice. The trade that everybody's cursing last week, right? No. At certain times, okay, I've said it over and over and over again, right? You can choose to listen, right? Okay, you can choose to totally ignore it, but the story is always going to be the same, right? I enter a trade because I told you it's a profitable company, right? And valuations are cheap. Will I be correct immediately? I may not, right? I was wrong, okay? But I know what I'm doing and I'm comfortable with what I'm doing. So I'm going to sit, right? And sit was what I did, okay? And let's see what the stock did. Right after we got in, the stock plunged to a low of 1990, right? So some of you, had comments where, that was loser. Hey, this lost a lot of money because, right, you didn't understand the concepts of what we're doing. Yeah. Okay. Now, so that's why I want to take a session today to try re-emphasize the concept. Okay, and hopefully you do understand that. Yeah. Okay. Now, so now that it's bounced over here, right? Let's check our trade and see what we've got. Okay, so we collected 90 cents for a 16 July 23 puts. Okay, so let's see where we are at now. 16 July 23 puts. Yeah, all right, we're not too bad, right? It's like what, 130? Okay, 130 right now. So, we haven't lost much. So I'm fully comfortable with this. Yeah, Baidu will be a good trade. At 180, oh yes, we got a great bounce on Baidu over here. All right, so let's have a look. It's a trade all the way to December. We collected 1530 on it, right, for about 2 weeks ago. All right, let's have a look. 180 put, 17 December. Voila. All right, we can close it today for about $11, right, $11. So if I do close it, all right, we make $4. All right, if we close it today, right, we will make $4.30. $4.30 on, right, $180 investment. Oh man. Right, so this trade is going to pay me 2%, everyone. It's going to pay me 2% in 2 weeks. Right, so now comes the crunch time. Right, 2% in 2 weeks would mean that my annualized return right now on this trade, right, it's going to end up being 62%, right, if I close it today. Right, so I did it in some of the last couple of sessions, and I said this, right, if I started a trade with an annualized rate that I'm happy with, right, which hits my target, right, anytime I get to close the trade earlier for a profit, right, this annualized rate is actually going to shoot up. Right, so when I have trades along the year that does this for my portfolio, right, that's how, right, on certain years our portfolio can actually drive up to 30% or 35% even, right, when we do things this way. All right, so here today we're going to take profits, right, on Baidu over here. All right, so I'm going to take profits on Baidu, and I'll even pay, right, up to 1120, right, to close this today. All right, so we'll do this. All right, we'll take 1120, we'll pay, and we'll get this close. All right, so that will bring my profits down to 4.1. It's still 59% overall. I'm happy. All right, so we closed out another winner over here. All right, 1120. Let's close it. All right, so we got $410, all right, for one option contract on this trade. Today is 25th June. Right, so I release $18,000 from my portfolio. That brings down, yep, awesome. Another profit, another winner. Right, now let's check in on our Kroger, our last trade over here. Anybody did the Baidu trade? If you did so, you can leave a comment and let us know, yeah? Right now, so our Kroger trade has also done well, right? So we have a 16 July with 3 more weeks to go, right? And we have a 37 puts. They can be closed for 19 cents today, all right? Closed for 19 cents today. So let's do a calculation as well. All right, let's get the original trade first. This is the original trade, right? And let's do the new trade. If I close this for 19 cents today, all right, what's going to be my profit? Equals to 32 cents. Correct me if I'm wrong, okay? 32 cents on $37. All right, so that's going to be 1%, right, or 0.86%. Now, but this would have been 1 week, right? A 1 week trade, right? That will boost the ROI up to 45%, right? So yes, I'm going to take this, right? Another logical reason to look at it is this, right? Jenny. Okay, now another way to look at the trade is this, all right? I entered the trade looking to get 51 cents in 4 weeks, right? But today, right, I've collected 32 cents in 1 week, right? Does it make sense for me to get out? Of course it does, right? Because now I'm only going to end up making 19 cents in the final 3 weeks, whatever for, right? I might as well get out of this trade right now. Okay, so we're going out of another trade over here. Right, we're going to realize 2 winners, right? Another 2 winners for our portfolio. Awesome. All right, everyone. So 2 more winning trades. We're going to close it out. Okay. All right, William, I'll cover it on Monday in our membership sessions. All right, these are public sessions, so I will not cover members trades during the sessions. Yeah, okay, so I'll cover it on Monday, William. Okay, everyone, so these are the actions that we put on our portfolios. And with these 2 closures, my portfolio exposure is brought down. We are back down to 57% of our $100,000 base portfolio. Yeah, okay, we are back down to 57,000. Yes, all right, 57,000. Okay, all good. We have 56 trades in total, right? 4 trades plus 1 portfolio hedge. 5 left open, so we've realized 51 winning trades with 5 open trades. Yeah, okay, 51 winning trades with 5 open trades so far for the entire portfolio. All right, thank you, William. All right, so they are going to be members trades, so I'll cover it in member sessions. So Eileen's question is, Terence, if I miss the trade on Friday when you do sessions like these over here, can you enter it on the following Monday? All right, simple case. Look at what the premiums is. Right? Are you comfortable with the trades? Are you comfortable with the premiums? Calculate the ROIs. Are you comfortable with the ROIs? Do you have the capital to buy the stock if you're going to go ahead and do the trade? Yeah, all right. So those are your considerations, right? Hence, like we said over here at the start of every session, right? Okay, I have to put this again, right? Do your own due diligence. Do your own risk assessments. Are you happy with all the risks potentially involved, right? All the profits that come from the trade. Right, if you are, right, then go ahead and do so. All right, but please make sure you do your own risk assessments and judgment before going ahead to do that. Yeah. Okay. All right. Now, so that's what we're gonna do over here. And one last call, right? Because this is gonna happen next week. So many of you have been asking. Many of you have been, going out there and trying to find out more information from us about 24 hours. Yeah. Right, so I've decided to host only 1 special session, everyone. Okay, I'm only going to do this 1 session. Right, so you make sure you do not miss this out if you want to find out how you can join us and trade the Q3 earnings season. Okay, so Q3 earnings season is going to happen in less than a month from today. All right, so we're going to kickstart the Q3 or Q3 earnings season, right, really, really soon. So if you want to make sure that you get to join us with the strategy, yeah, okay, all right, please make sure you do not miss out. Okay, so just some simple sharing, right? What kind of returns can you be making? All right, this is one of our students, right, who have learned the strategy and traded it on the 1st of June. Yeah, okay, so he did 4 trades over here. Okay, we returned spending from 6.7% all the way to a high of 31.9%. Yeah, okay, so these are some typical trades that our students get their hands on. Right, in our Facebook group, many of you have already seen, all right, that a lot of students have done well with this strategy. Yeah, all right. So here's the same student again, right, with 29 wins and 6 losses. That hits a win rate of 83% so far. Right, and another few trades, CIEN, all right, with a 26% returns. Yeah, all right? So these are all pretty good results on explosive earnings that we have collected and done. Right, Simon over here, right, 85.7% win rate. Yeah. Now, so if you like to find out how you can trade earnings season, all right, very accurately, okay, and generate some of those big profits that we have out there, all right, please make sure you do not miss this upcoming session, okay? All right, now, so yes, it's going to be a one-time only free introduction sessions where I'm going to share more, right, about, oh, thank you, Anando. All right, I didn't solicit this, yeah? All right, okay, now, if you want to accurately observe and follow what we call the big boy movements pre-earnings, okay, let me be less gender or sexist this time around, okay, all right, big players movement, okay, pre-earnings, all right, then you want to make sure that you attend the session, okay. We trade this with low capital requirements, so most of our trades start with as low as just $100, right, per option sold. That means if you have $100, all right, you would be able to follow our trades. Yeah, okay, so these are some of the trades that we do, the strategies that we adopt. Now, so there's absolutely no stock ownership required because we enter the trade the day before earnings is announced, all right, and we close the trade the day after, which is where the earnings is already announced. So we don't even hold it to expiry. We open and we close it the next day. That's why it's called 24-hour, because it's supposed to represent 24 hours. All right, so there's a turnaround 24 hours trade. We open the trade before earnings, we close the trade once earnings is out. Right? It's a very event-driven specific trade, right? Which requires very, very low capital. In fact, we have many students who started with only a $1,000 account, right, or $2,000 account, and you'll be able to do this as well. Okay. Now we make sure we define our risk for every trade that we take on. Right. So in fact, right, with the $100 that you put up, that is technically your maximum loss. Okay, but Hernando can probably justify what I said. Right. Most of the time, the losses are not even anywhere near this amount. Yeah. Okay. Now, and our trade returns for each of our winning trades span anywhere from 20 to a high of 60% over here. Right, in a one-day trade. So imagine if you learn how to lock in one-day trades with 80% accuracy, right? And each of the time they generate 20 to 60% returns, right? You're gonna have a very, very profitable system over here, right? So thank you once again, Hernando, right, for sharing with everyone, right? You recovered your investments in a week, right? And then another 4 weeks more, right? It's all pure profits, yeah, all pure profits. Okay. Now, so when is this session happening? All right, what are the details again? All right, one last time. It's going to happen on the 1st of July, a Thursday. All right, 1st of July, a Thursday, which is next Thursday from now. So if you have not registered, okay, if you have already done so, you don't need to do this again, okay? But if you have not registered for this special session, right, here's the link. All right, I will also put it up. Okay, inside the session over here in the banner. All right, so it is bit.ly/24hour special. Okay, it's on the 1st of July. We'll start at 8 p.m. All right, and I have only one session planned. Yeah, okay, so if you'd like to find out more about how we trade some explosive profits during earnings season, which is going to come up for Q3, all right, just register yourself. Okay, Facebook user, you want to see Hernando's comments. All right, here you go. All right. All right, thank you very much, AK. All right, thank you very much, AK. AK has added as well. All right, so please make sure you go to the link, register yourself for the session, so you'll be able to find out more details about how we do the trades, right? And then decide if you want to be part of the action as well. Yeah. Okay, so AK as well has said 24-hour is really simple to follow. There's no need for huge capital, right? He's new to trading. Oh, AK, I didn't know that. Right? So you're new to trading and you could follow easily. That's awesome. Thank you very much. So profit pays for the fees, all right? He will recommend this. All right, now, so with that, I'll end today's session. I hope it was really beneficial for you, right? So once again, if you found that you have benefited from it, right, register for the upcoming introduction sessions. Help me click the like buttons before I end off today, right? And also click on the share buttons, all right, if you want to make sure that you receive, right, the infographic. Yeah, okay, so you want the infographic for selling portfolio puts, please make sure you hit the share buttons. Right, the team will check who has made the shares, okay, and then after that, contact you to send over the files to you, okay? All right, thank you very much. And one last one. All right, yes, we can do it with small capitals even. All right, awesome. Now, so thank you very much for joining me once again, and we will resume portfolio building next Friday, okay, with adding of new positions. Now they have cleared some up. Thank you very much, and I'll see all of you in our introduction sessions, special intro session on Thursday for 24-hour, and then for Friday, our public session as usual. Thank you very much, and have a good night, everyone. Have a great weekend. Bye-bye.